So what you're about to watch is a training that I did over an hour long, step by step, where I break down from the beginning what option is and the two sides of options in my strategy, which is the buy side and the sell side. And this is going to be the best video you've ever watched on options trading, I promise you. Today, I'm really going to be showing you guys how to make 5 to 10K a month from options starting from scratch. And that's just kind of scratching the surface. We're going to go a lot deeper than that, okay? And really what I want to give you guys is an understanding of what options trading really is and how and why it's used. Um, as you guys know, me, I've been doing this for about 9 years now, day trading, swing trading, everything in between. And there's some things that I've been doing for a couple of years that I haven't really shared publicly because, not because it's advanced, but because people just don't want to necessarily think. Or once you figure it out, it gives you access to the road, right? That's what this is, okay? So that's why this is different, okay? So what it's going to do is help you guys understand risk and also give you the power of a hedge fund owner. So if you literally learn this, if you guys have heard me help me say this several times, you can actually go out and create your own hedge fund. Seriously. If you guys have any questions, make sure to ask it in the chat and I'll go through it as well. Okay. So my goal, guys, is to show you guys how to make extra income doing this, build your financial house, and I want to show you how to maximize profits, only making 2% a year. And this is all about leverage. So the questions I will answer, what are options? Great, let's get into it. First thing you need to understand is options are like real estate. Okay. What do I mean by real estate? If you're buying a house, right, in DC, right, let's say the house is 500,000. Okay. They ask you to put, what percentage did they ask you to put down on the house now? Is it 3.5 or 5%?
Well, we was 3.5.
Okay. So they ask you to put 3.5% down, right? Which on 500,000 is 17,500. And then you get to control the whole 500K. Here's the question. If this 500K in 1 year goes to $1 million in value and you sell it, do you get to keep that extra 500K in equity or not?
Yes.
Yes. Yep. Exactly. That's literally exactly the same way options work in a rudimentary version. You're controlling, let's say, 50,000 worth of stocks, but instead of 3.5%, you can literally control 50,000 worth of stocks for like $500. And for those who've bought options before, you know this is the case. And when that appreciates, let's say this 50,000 turns to 52,000, you actually make that extra $2,000 difference, and now your total balance is 2,500. Are you guys following this so far? Does this
Yep.
make sense?
It does.
Okay, great.
Yes.
So now, what you've been hearing about all your life is buying options. Okay, there's another side to it, which is selling options. Now, this is where the rubber meets the road. This is what the bitch hedge funds don't want you to know. Because when you understand both sides of the equation, it's like mixing iced tea and lemonade. Like you get the benefits of both. Selling is for income generation and buying is for income multiplication. So this idea here, up here, where you put $200,000 into a stock and then it raises up and then you get the equity that's on the buying side. Okay. Write this down, guys. So when you're buying, you're multiplying your income. When you're selling, you're generating income. The second thing you want to write down is when you're buying, you have a lower probability of profits, lower probability of profits, but an unlimited return, potentially unlimited return. Let me see what I can write a little bit clearer here. I'm sorry, guys. But just right now as I'm saying it. So when you're buying, you have a lower probability of profits, which means that you might only have a 50% chance that the trade is going to go your way. But the income you're going to make for it, because it's a multiplication tool, it's actually unlimited. Because if you have a 200 call on Tesla and Tesla goes to 1 million tomorrow, you have unlimited income. It can always go up, but the bottom at max is 0. Are you getting that? Okay. So
Yep.
when you're buying options, the most you can lose is what you put in, but the most you can gain is unlimited. When you're selling options, You have lower income potential, but a higher probability of profits. So it's literally the inverse. So what does that actually mean? That means if I had, let's just say a $10,000 account. If I had a $10,000 account, if I'm buying options, let's say I put 1K in a call, I'm swinging it, okay? This 1K can go to 10K in 6 weeks, okay? And even higher. But the probability of that happening might only be 25%. Are you guys following? But in the same 10K, let's say I put 1K up, risk 1K in a trade, the same risk. I'm only going to make for that 1K $75. But the probability of me making that $75 is 95%. Now, I want you guys to really sit and think right now. This is where the money is made. And this sentence that I just issued right here is literally the difference between you working again and never working again, if you understand certain things. If you have a 95% chance of making money and $75 out of 1K is literally like, what is that? That's like 8% on your money, guaranteed. And mind you, this is in 1 week. This is not like you're waiting like 2 weeks or 3 weeks. This is a 1 week guarantee. Which trade would you rather take? Well, the question is, it depends. It depends on your capital, and it depends on what you're trying to do. Because in the same case, you're risking the same 1K. The difference is, one, you know what you're making up front. This is the max you're going to make, the $75. One, you know what you're risking up front, but the potential is unlimited. What I do is I mix the two. Okay? For the best outcome, you mix the two. So I'm going to show you an example of this literally right now. Let's go to Meta. Okay, let's go to Meta. I was just looking at this 10 seconds ago. Share. I'm going to share this. Guys, this is Meta. Okay, you guys see the screen?
Yep. Yes.
What I'm going to execute right now is called an iron condor. Okay? I'm going to explain the mechanics to you a little bit later, but I want you to just watch what I'm doing right this second. So this is Meta. Today is July 20th. These were the prices as of Friday. So if I executed this trade on Friday, this is what I would have made. Right now, Meta is at $704.28. Are you guys seeing that? As of the close of Friday.
Yes.
Yep. Great. If I right clicked and I literally create sell iron condor, okay. What I do is that the reason I want the 655 is this thing called a delta. The delta shows you two things in any options trade, whether you're buying or whether you're selling. The delta is the amount of money that your options contract is going to gain every dollar the stock moves up. Okay. It's also the percentage chance that the stock is going to get to this number by this expiration date. I'm going to say that again. The delta is both the amount of money your options contract is going to gain or lose as the stock moves up a dollar. So for example, if I bought the 655 put and Meta went down from $704 to $703, this contract will go from $60 to $64. Are you getting that?
Yep.
Great. But it's also the percentage chance that it's going to reach this level by the expiration date, July 25th, which is this Friday. So go ahead.
I was going to add, excuse me, is that 4% or 40%?
0.04 is 4%.
4%. Okay.
Because remember, everything is multiplied times 100 with options contract. Okay. So if you own, just like this isn't 60 cents, it really means $60 because it's 0.60. Are we following so far?
Yep.
Great. So if it's 5% is going to get here, I'm going to choose something that's $10 out of the way. So 655, let's say to 640. Okay, 655. Where's the put? I'm going to do 640. And on the call side, I'm going to look for 5% again, the delta. Okay, 5% of the delta, which is right here. This is 755. Okay, so I'm going to change this to 755. And then 785. Are you guys seeing this so far? And I'm going to change this to one contract. Don't worry about the buttons I've pressed so far. I will explain it later. What this pretty much means is that you see this word here that says credit. That means as soon as I hit the sell button on this, I'm going to get paid $67 per contract. Are you guys following so far?
Yep.
Okay. But not only am I going to get $67 per contract, I'm going to risk about what? 3K. So you're risking 3K to make $67, right?
How do you know you're risking 3K?
You see it says max loss?
Oh, okay, okay. Biz max loss. Okay.
Max loss,
Where's that at? I don't see it.
I don't see it.
max loss,
Oh, the M?
right here, max loss. You don't see this order confirmation screen?
Nope.
Okay, I need to share my screen a different way then. I'll share it with you guys. Hold desktop 2. Or desktop 1. Can you guys see this max loss button now?
Yep. Now it's
Perfect. Okay.
Yes,
great.
yes. Okay.
Max loss is $39.33. Max profit is $67. So here's the difference between buying and selling. When you're selling, you have a max profit up front. Okay. The difference is though, the percentage of you making that profit is 95%. And the way you're going to keep all of this money is if Meta stays between now and Friday, if Meta stays between 655 and 755. So in literally 5 days, if Meta stays within $100, which is 95% likely, you're going to make $67.
Well, yeah, that makes sense. Well, let's bound to stay within the $100 range.
And that's the point. More than likely, it's going to stay within $100 range. But now imagine if your account was $30,000, and instead of buying one, you bought 10.
Should it be positive? Oh, no, because we're selling it. Okay, never mind.
No, it's going to be red, but look at this.
Right. Wow.
Now you just generated $670 weekly income for yourself every week like clockwork on the.
Hey, Josh.
Go ahead.
Is this because like where the market is kind of trending right now is like not that much like fluctuation? So something like this makes sense because it's like there isn't that much movement in the market. Does it make sense?
Yeah. So if the market stays or this particular stock stays within that $100 range or within that range you choose, then you're going to make that money. So you can pick stocks that literally don't have to be as volatile as Meta. I just chose Meta as an example, as a stock that's kind of volatile. We can even do this on Tesla. I'll show you guys Tesla. But so that means that you will risk $30,000, which is your max loss, right? But you're going to make $670 every week. So if you did this once a week for 4 weeks out of the month, you just generated pretty much $2,300 a month in it. Did I do that math right? But let's say you have a 401k somewhere and you have 100,000. Now you buy 30 of these. And as soon as you hit execute, you're going to get $2,000 a week in income. Maybe with the $100,000, you can replace an 8K a month net salary. Just showing you guys what's possible. And I'm going to show you guys what you can do with small accounts as well.
Hey,
But
Josh.
go ahead. Yeah.
Sorry, quick question. So say if it doesn't go the way, so it says the max loss would be the 30,000. So
The
what
ma-
would right? So let's say if it gets out of that range, then you automatically lose 30,000, or does it start at a lower number?
No, so you don't just lose. Let's say that it goes to, let's say the range we chose is between 655 and 675. Let's say it gets to 770. You don't just lose all of your money. Your profit starts decreasing as it goes up.
Oh,
So if you're noticing that it's getting close, just close the trade. Like here's the benefit of closing the trade, right? I want to show you guys something. Right? It's literally showing you as you're going. This is not the chart I'm looking for. I'm trade chart. Show. All right. Analyze trade. Okay. It's going to show you as literally, this is not what I'm looking for. I'll find it later, but it's similar to this. But what it shows you that as the stock moves closer, let's say this was 755, this was 655. It's going to show you as it's getting closer, how much of your premium you're losing, okay, and how much you're making. Does that make sense? So if it gets close to your level, you can literally close the trade for break even and literally not lose any money. You don't have to watch your money go to zero. You can literally close out the trade at any time you want. Does that make sense? And this is just for a range. Let's say you don't want to cap. Let's say you don't want to cap the trade. Let's say you think, hey, you know what? I think Meta is going to keep going up. I think Meta is going to keep going up. So I don't want to have any risk on the upside. I just want to sell on the downside. I just think that no matter what happens, Tesla is not going to go below $650. You can literally come here and sell a vertical and do, okay, $650 put. Okay. And you hit confirm and send. So now you're only making $33. So you see, you're making less money because you're taking less risk. Like you're not keeping it within a range. But now, as long as Meta doesn't drop below 650, no matter what happens, you're going to keep this money. And again, this is also, I chose 3%. I should have went to 5, right? And sometimes I go as much as 10% where I want to make literally, so let me do 670 and 650. So now, because I'm taking more of a risk, quote unquote, instead of a 95% chance of it happening, it's now a 90% chance. Huge difference. I know. I'm literally making double the profit. So now I'm risking, look at this, I'm risking $1,900 to make $100. That's about 5%. So if you have $1,900 in your account, that's your max risk. Your guaranteed profit in 1 week. That means by Friday, if Meta doesn't drop down to 670, which we all know is very unlikely if you look at the chart, you're going to get to keep this $97. Now multiply this again by 10. So if you have a $20,000 account, $19,000 exactly is what's going to cost you. It doesn't cost you as your max loss. You're going to make $1,000 a week on 20K, like clockwork. With a 90% probability it's going to happen. You're going to keep the money. And next week you do the same trade over and over and over and over again. So if you had a $100,000 account, instead of making $997 a week, now you can make $5K a week, which is $20K a month with a $100,000 account.
wow.
I hope you guys' wheels are spinning.
They are.
Literally, people just stay in this market and make so much money so many different ways. This is so cool.
Like that's what I said. When you guys understand both sides of the equation, the things you can do with this is crazy. And I promise you, I have barely scratched the surface. This is called a vertical. Okay. Now let's go back to the chart. Let's go back to the trading. So I want to break it down to you guys step by step so you guys completely understand it. I just wanted to show you what I meant, the difference between buying and selling. Okay. So what I just showed you guys is what's called a vertical. But on the buying and selling side, there's two things you can do. As a buyer, you can buy longs and shorts, which is calls and puts. you can also buy leaps. Okay. For those who don't know, leap are options contracts that are more than a year out usually. Now, I'm emphasizing this for a reason because I need to show you guys what you can do with this on a bigger level. Have you guys wrote this down? Can I erase some of this so I can make more space?
Yeah, I'm
All right, perfect. We'll help me get this out the right way because I really been thinking, I was like, how can I say this in a way that's going to make the most sense for you guys? So you guys understand what you can really do with this, especially with like whatever your account balance is, right? So we have the buying side and the selling side. Good. Every options contract, how many stocks are in that contract?
100.
100.
100. So on the selling side, the very basic of selling is called a cash secured put. That means that you have to have 100 of those shares. You have to have enough money to buy 100 of those shares. Okay. And when you do, you can do a cash secured put. And what you're betting is that the stock is not going to go below X number. So let's say Meta is at 700 and you say, hey, if Meta gets to I don't know, 600, I'm willing to buy it. Okay. But if it keeps going, I don't want to buy it. The way you can enter this trade is called a cash secured put. As long as you have 100, the cash to buy 100 of the shares at the strike price you choose, you can execute that trade. So this is the very basics of it. And I'm going to teach you guys what's called right now the wheel strategy, right? Selling puts and cover cost of the wheel strategy. Okay. I showed you guys a little bit of the spread in iron condors, but I want to show you guys, this is like the elementary 101 of this, right? So if we go to the chart, and let's say right now Meta's at 704. Mind you, earnings is coming out on Meta in like 2 weeks. So you can do this for a week. If some of you guys you want bi-weekly income, you don't want to get paid every week, you can do this strategy bi-weekly and literally make it just like a paycheck, right? If you want to get paid every week, you can get paid every week. But let's say in 2 weeks, I say, hey, in 2 weeks, because in 2 weeks Meta has earnings, within 2 weeks, Meta is not going to drop below $640. And if I literally hit sell one single of this, just one, they're going to pay me 500. You see, it's going to say the word credit, $500 minus your little 65 cents fee, the criminals. Okay.
It's not showing it again.
Oh, it's not. Oh my gosh. Okay. Let me show it the right way. Thank you for telling. Can you see it now?
Yep.
Great. So let's say I sell the 640 put. I'm going to immediately be credited $500, which is my max profit. You see that? But my max loss is 63,500. Don't let this scare you. The reason why the max loss will be 63,500 is, let's say it does get to 640 and then Meta goes to 0. Then your max loss is 63,500. Is that registering?
The options contract goes to 0 or the strike price goes to 0?
No, so
Stock price.
when you're selling puts, what you're essentially saying is, if Meta gets to $640, I want to buy 100 shares of it.
Okay.
So you need to have 100, you need to have the cost to buy 100 shares of Meta at $640. That comes out to $64,000. Are you paying attention?
Yeah.
So let's say I do want to buy Meta at $640. Because I sold a put to do it, they're going to pay me premium of $500 for selling that put, which is why your max profit here says credit $500. Are you seeing that?
Yep.
Okay. Minus your fees is going to be like $4.99, whatever, $500. Now, if Meta doesn't get to 640 in the next 2 weeks, guess what happens? Nothing.
Nothing, right? You keep all of the 500?
You keep all the 500 and nothing happens. This is literally what we in the industry call ghost money. You don't own the shares. All you have is the cash, and you're getting paid cash for having cash. It's literally printing money. The only caveat is you have to have $63,500 to be able to buy just one of these. Okay? I'm going to show you guys how to maximize this in a second. So this is the basics of selling. This is the basics of selling. 63,500. Let's say you place this trade, you're going to get $500 in your account for placing this trade, and that will be the end of it. Does this trade by itself make sense? Selling cash secured puts.
Yes.
So if there's any stock that you think is going to keep going up, especially in the S&P 500, the top 50, and you just want to make extra income from it, just sell cash secured puts on it. It's very easy and basic. And guess what? The worst case scenario, if it gets to 640, they're just going to make you buy the shares. That's it. But that's also a good thing, and I'll tell you why. Because then you can do the other side of it called covered calls. But I want to make sure you understand this side of it very, very completely. That you're selling a put. So instead of you buying insurance, you're selling insurance. And you might ask, who the heck is going to pay me $500 to secure this? Well, there are people who have millions of dollars in Meta and they want to protect their downside. So what they do is then they buy insurance on their money, on their stocks. And we, as nice people, sell it to them out of the generosity of our hearts for the $500 they're going to pay us. And I'm kidding about the generosity. You get what I'm saying? We're selling it to them because we want to make money. Okay. But yes, we make $500 for doing this. Okay. So that's what you're doing when you're selling puts. Is it making sense so far?
It is. So it's 640. So if it was 639, if it came in at 639, would you still get 500, or would it be a percentage of 500? Like if you sold, I guess because you're buying it, if you sold it before it hit 640, would you still get the entire 500?
Great question. Now you're thinking. If it starts getting closer to 640 and you don't want to risk it, your profit will go from 500 and might become 250. Now you have a choice. You can close out that trade and keep the $250 and walk away from the trade and keep 250 and just got paid 250 for just matching the trade. So you don't have to wait for it to get to 640. You can literally sell the trade at any time, just like you can sell any option contract at any time. You can also close this trade at any time and keep the profit of that particular day.
So what's to keep you from just doing this daily then?
That's literally the whole point. While doing it daily, it depends on how much you want to watch it. And if you do it daily, there's no daily option contract. It's only weekly.
Well, no, like you do a weekly. Okay, so it needs to get close to maturity before you would see. No, because you said you'd get the credit immediately. So if
Yeah,
I
you
just
get the credit immediately. You get the credit immediately.
So if I did a weekly, but then closed it a couple of days in, and if it's still around that same price, it would still be the $500.
Exactly. And now you're getting it. Now you're thinking like a professional. That's exactly what you do. Sometimes, let's say on a weekly, I can wait 5 days. But let's say you buy something. I'll give you a perfect example, right? I'll give you a very perfect example. Let's say the market is dumping. The market is going down. I'm going to go, instead of going to August 1st, selling the put, I might go to December. Okay. And then I'm going to look for the probability, 15%. So there's only a 15% chance that Meta is going to get down to $575 by November. We all know that the likelihood that Meta is going to go down to $575 by November is slim to none. To be honest. But if I have $57,500 in my account and I sold one of this, immediately they're going to deposit into my account 1,000. I put 6. I have 1. Immediately you're going to deposit into my account $1,430. Here's the key. As Meta keeps going up, okay, the cash that you get to keep increases. So let's say in 2 weeks, it says, okay, in 2 weeks' time, I get to keep 800 of this 1430. I can either keep 800 now or wait 3 months for an extra 500. I'm going to close the trade now and keep that $800. Are you seeing that?
Yeah.
That's how we manipulate it. Literally, that's how you manipulate it. I'll just show you guys the basics so you can literally see how simple it is. But now you're thinking like I think, like, what if I just want to just sell and keep the money that I make now? Yes, you can do that. Absolutely. This is why I said knowing both sides of this is a huge game changer. But again, I'm just doing it to like you want to pay yourself weekly, like you were at your job, or bi-weekly. Like you can just start making money doing this. But what if you don't have? So that's the basics of we're in 2 weeks out, right? That's the basics of selling puts. Okay. at 14%, we would get this 500. But let's say worst case scenario, we're selling. Let's say worst case scenario, it gets to 635. Okay. So you have to buy the 100 shares. You put up the 64,000 minus the $500 you paid. Because remember, your max loss is 63,500. Why do I have 6 here? 1. This thing is used to my orders too much. Okay. Remember, your max loss is 63,500, right? The reason it's not 64,000 is because you got paid 500 to put on the trade. So no matter what happens, you're keeping that $500. But let's say you get the stock up to 635. Now you own Meta. Now you go to the other side, and now you sell the call. But you don't want to sell at 15%. You want your money back. So you want a high likelihood that in 2 weeks this is going to sell. So we're going to go to a delta of like 0.5. So there's a 50% chance that in 2 weeks, Meta's going to go to $710. So what are we going to do? We're going to sell it. And how much are we going to get paid for selling it? The call. If we had one. Give me a 6. How much are we going to get paid?
2,400.
Great. So you got paid $500 to sell it. You got paid $2,400 got paid $500 to sell the put. You got paid $2,400 to sell the call, which is about $2,900. And you also make the difference in the cash. So if Meta went from, let's just say 700 to 710, that's $10 per share. And you have 100 shares, that's another $1,000. So you just got paid $3,900 that month for placing the trade. This is called the wheel strategy. It's a win-win. Whether the shares get assigned, whether the shares don't get assigned, it doesn't matter. You're going to make income no matter what. This is why I tell people, if you can find a way to get your hands on $100,000 to $200,000 in cash, you actually never have to work again a day in your life. Like seriously, if you understand this. Because I'm showing you how to generate weekly income, bi-weekly income. Even if you get filled, you do this. But let's say you have a smaller account. This is where the verticals come in, and I have to explain this to you. But do you guys understand this concept of the wheel strategy before I move on?
I'm a little cloudy on the call side. Like why is the max profit so much higher than it was on the sell side or the put side?
You make more money when you're selling calls. That's just what it is. They're willing to pay more premium. Because think about it. If somebody's buying your call, they're buying your call because they think it's going to skyrocket. So they're willing to pay more because it's a limited upside. On the downside, the worst that it can get to is 0. On the upside is unlimited upside. So the premium is going to be more expensive on the call side than they are you're going to get paid more premium on the call side than you do get on the put side. So I know some people literally don't have 200,000. Let's say that is your favorite stock, right? They will literally go out and buy $100,000 worth of shares, and at the same time sell $100,000 in cash. So they'll do the covered calls and also do the cash secured puts at the same time, so they're getting both benefits together to maximize their cash.
Is it also because of the delta? Like the delta that you ended up picking was like 0.50%, and then
Correct.
the put was 0.15, I think.
Exactly. So remember, when you're selling puts, the more conservative you are, the more you want to go down in price. So for example, if you don't want to get filled, you just want the cash for doing nothing, you want to go as low on the delta as possible. I usually do somewhere between 0.5 and 20% when I'm selling cash secured puts.
And think of that as your risk, kind of. Yeah. Because it's a 5% chance to a 10% chance that it could get to that price.
Exactly.
Gotcha.
And that's with the cash secured puts. So when I'm doing cash secured puts, I'm willing to go a little bit higher, because with cash secured puts by itself, because you have the cash in your account, you can go around and sell it and do this on the other side. You can do the wheel strategy. So sometimes our cash secured puts, I'll go as high as 30%. So what that looks like, if I went as high as 30%, what that means is 0.30. That means that for every $67,500 I have in my account, I'm going to make $1,300 every 2 weeks. That's a $50K a year job. Okay. So that's cash secured puts. Now, let's say I get filled at 675. If I want to keep the shares and I want to just keep the shares, so I'm willing to get paid less money, maybe don't go to 50%, maybe go to the same 30% where you're going to get paid $1,100. And if in 2 weeks, because remember, this is in 2 weeks, it doesn't get to $740, you get to keep that $1,300 and do it again and again and again and again and again. That's why it's called the wheel strategy. But let's say you get filled, right? If you get filled, you get paid the difference in the share price and you get the premium on this side. And guess what you do the next week? You go and sell. And you repeat that cycle over and over and over and over again. This is the real strategy. This is options trading 102. Okay. Yeah, guys, I haven't even started. Trust me. Trust me, I haven't even started. Okay. Now, yeah, Shane, this is definitely the blueprint. Now, you guys tell me, should I go deeper or should I just focus on this?
I mean, let's go. It was if you do it like with a lower price one than what you're doing with the 60,000 one.
Correct. So we can go to, let's say we go to, and that's why I like stocks like, let's go NVIDIA, right? And I'm going to show you a way to do this. If all you have is $1,000 in your account, you can make money. It's called I'll show you that in a second. Okay, so I guess I do have to go deeper. But let's say in 2 weeks, NVIDIA, I'm willing to buy NVIDIA at freaking what? Let's say I'm willing to buy NVIDIA at $165. So if I have 16,500 in my account, I'm going to get paid $190. Okay. Now that seems small, but I want to show you guys something early, right? If you're making $190 every 2 weeks, which ends up to be $190 times 2, which is $380 every month out of a $16,000 to $17,000 account, you're making about 2.2% on your money. I'm going to show you how to make 2.2% a week on your money. Now, I'm going to show you a chart that if you start with literally $10,000 and you do what I showed you, in 15 years, you're going to turn $10,000 to $10 million. If you believe that that's true, type of 1 in the chat. If you don't believe it, say 2, type of 2. Like maybe Josh is blowing smoking again. Okay. Now, mind you, this training I have never shared anywhere in public. It like ever. Like nobody ever heard me go into this. So you guys are in the secret card. Like, not a card. Oh my gosh, but you get what I'm trying to say. But I'll just
circle.
second. Yeah,
It's the inner circle, exactly.
There we go.
Exactly.
So some of my
Thanks,
clients
Marcel.
with like the higher net worth, the 100K, 200K, 300K, 400K, this is all we do because like, why not? You can literally just make income from your money. But yeah, this is what we're doing, right? We're selling options. Now, the wheel strategy, like I said, when you're selling calls, if you get filled, you can go anywhere down the chain you want. You got a question, Shayna? Go ahead.
You can finish this thought so you can finish the conversation and I'll ask the question after.
Okay, you can go anywhere down the chain you want. And remember, the delta is the percentage chance of it happening. So if you want a 0% chance that you're going to get filled, you can get paid $3 for your efforts, right? Depending on how many shares you want. But somewhere between 10 and 30% is usually the goal when you're on this side and when you're doing cash secured puts and covered calls, okay? But when you're doing what I call verticals, you want to be more conservative. So write this down. When doing cash secured puts and covered calls, you want to stay in delta between 5% and 25%. Okay? For cash secured puts and covered calls, you want to stay between 5% and 25%. Okay, go ahead. Ask your question, Shayna. I guess she's gone.
Sorry, guys, I'm my bad. I was typing on my notes. Thank you for that information. My question is, and this may not be the proper space, but since we just called ourselves the inner circle, this is a question. Can you as we grow in this skill set, and because I meet a lot of elders, not just elders, but people who just don't have time to just be to do this in the market, they have other things going on. So is it legal to just basically do it for them in their account, and then you could take a service fee? like whatever, you know? So that could be another way. Like if you want to do that, is that legal? Is that like a hedge fund? I
Good
need to
question.
learn all these terms.
Yeah, so that's what I mean by hedge fund, where you can
Oh, okay.
help
Okay.
people kind of manage your money. Now, there's two ways to do it legally. Number one, you can go through the SEC route, register as a hedge fund, register as a financial professional, and that's going to take you $60,000 in paperwork and lawyer fees. Ask me how I know, and also time and energy. Or you literally just create an LLC, partner with somebody, tell them you trade their money for them, and you
Mhm,
make conservative trades, and then
mhm.
you literally just say, hey, your account's going to grow very like slowly at first, but then you're going to start seeing maximum growth. And all you want
Mm,
is a percentage or a fee,
perfect.
whatever you want to charge. And I'm going to show you how to do that right now. So I'm
Perfect.
going to give you an
Thank you.
example, right? Let's say you have $16,000 in an account, right? Or 60,000 in an account. You do this twice in the month, you've made $380. Is that making sense? Yep. So what can you now do with that $380? Instead of selling, what can you do with it now?
But you can reinvest it, can't you?
You can go on the buy side with
Mhm.
income essential is now unlimited.
Right.
This is what I call the hybrid method. You generate cash from selling and you use some of that cash and put it in long calls where you're literally paying and getting free lottery tickets. So you build capital, literally you're building it brick by brick. You're building capital by selling guaranteed cash, even though limited. And then as you're selling, now you go on the other side and then you buy. So for you guys in the swing trading group, let's say I had 100 grand and I sold 5 of these. Now I have $1,000. I can go now put on a Tesla swing. And now I can be willing to lose it all and I can wait for it to 10x and then turn to 10, 20, $30,000.
Okay, so make sure I'm getting that. So sell the put,
Uh-huh.
take some of the credit or all of the credit from that, and then just do your traditional swing.
There you go.
Okay,
Perfect.
So now you're protecting your original capital
right.
and all you're swinging with is profit. And if you do this long enough, give yourself 3 years, I promise you, your life is going to change. Because what you can then do is something called a poor man's covered call. And okay, I'm going to get to that in a second. I don't want to get too ahead of myself. Does this make sense?
Yeah.
Okay? Is this making sense so far? But let's say all you have in your account is three grand. How are you going to do that? Great. Well, it's different. I'm going to show you how. Well, even if you have 1 grand, right? So are you guys seeing this right here?
Yes, sir.
Okay,
The
great.
whiteboard.
So we have the buy side and sell side. Well, on the sell side, you can actually create an insurance term. What does that mean? Let's say you want to sell $700 worth of Meta, right? But you only have $3,000. You don't have um $70,000 to do this. What you can do is $3,000 is put your $3,000 as collateral. So what you're doing is you're going to sell the 700 call, the 700 put, and then you're going to buy the 670 put. And the difference between 670 and 700 is how much?
30.
30.
30 times 100 is 3,000.
3,000.
So that's your $3,000 risk. So here's where you have a choice. You can either take $3,000 of cash and buy a swing option, or you can put $3,000 in cash and sell what's called a vertical. And as long as Meta doesn't drop to $700 and below, you're going to get to keep the premium given. Okay, I'm going to show you an example real quick. Okay. So as long, remember, because you're selling a put and you're buying a put. So the risk in between is what you're responsible for. At this point, you are now an insurance company. Congratulations, you own an insurance agency. You're buying and selling insurance. You're writing and accepting contracts,
Wow.
right? So even though the whole 3,000 quote unquote is at quote unquote risk, You're leveraging that to get passive income. And this is why I said, when I'm doing these, I'm usually around 5% because I want a greater probability of the contract expiring worthless. That way I keep the premium. Okay. I keep the premium and I get to do this over and over and over again. When I'm just selling cash secured puts, I can go as high as 30% because I know if I get filled, I have the cash, I buy the shares, I'm going to go to the other side and sell covered calls. When you're doing verticals, because you're putting you're literally running an insurance agency, you're putting your own capital at risk, you want to give yourself the highest probability possible. So because of that, the cash you get decreases. I'll show you an example. We just did Meta. Let's go back to Meta. This is one of my favorite companies here. I'm going to go to the 5% delta. Okay, this is the delta here. 5% delta. Guess what? It's at 600. So they're going to pay me $160 to sell this. But I don't have 60,000. I only have 3,000. So what I'm going to do is sell a vertical. And then if I say, okay, between 600 and 590, that means that all I'm risking is $1,000. Are you seeing that? Every $5 is $500 of your own money you're risking. So if I go to $10, I'm only risking $1,000, but I'm going to get paid $38 for it. If I go to $30, which is 570, now I'm risking $3,000, but I'm getting paid almost triple the amount, $87 for it. Are you seeing that?
Yep.
Okay. So remember, the percentage chance that Meta is going to drop to $600 is only 5% in 2 weeks. So I'm going to risk $3,000 to make $85. The more contracts you buy, the more contracts you sell, the more money you make. Okay, this is called a vertical. So with people who have little accounts, they do what's called a vertical. So as long as Meta doesn't get to this point, you're going to make money. What I showed you earlier is the iron condor, when you do it on both sides. Where on the other side, there's a 5% chance that Meta, based on the delta, is going to get to what? Where's the 5% chance here? There's only a 5% chance Meta is going to get to $840 in the next 2 weeks. Slim to none. So I pretty much do the same order on both sides. I sell on the put side, I sell on the call side. And as long as Meta stays between $600 and $840, I'm going to get to do the premium. But the benefit is now, guess what? It's called an iron condor. Now the premium I receive literally doubled. So we're selling the 600, I remember, and we were buying the 570. And then I think we were on the call side. This is on the put side, sorry. 600, 570. And on the call side, 5%. Where's that 5%? We're selling the 840. And then $30 out of the 840 is 870. And we're buying the 870. Okay. And guys, for literally the same risk, the same $2,858 risk, now we're making literally double the profits, $142. So you can choose to risk $3,000 to make $80 or risk $3,000 to make $142 every week, which is about 2% a week if you do the math. More than that, it's about 2.7% a week. Are you following so far? Am I going too deep in the rabbit hole?
This is cool stuff. I'm excited. I'm excited for more of
Okay.
this. Thank you.
So that's the iron condor, right? So these are what I do. If you have a smaller account, this is what you do to literally collect income every week or every 2 weeks. I like doing this weekly. So every week I'm going to collect my $100, $200. It seems small, but an extra $80, $100 a week. An extra $100, $200 a week, risking only $3,000 with a 5% probability every week. That's an extra $500 a month. What you do with that is up to you, right? And remember, you don't have to do a 30-point gap. If you only have $1,000, you can literally go to a $10 gap, the premium would just decrease. Okay. Somebody had a question? Okay. I want to show you guys one more thing, and then I want to answer questions. I don't want to go too deep. I think I'll just leave it here. But I want to show you guys something called a diagonal call. Pretty much, it's called a poor man's covered call. So let's say a year from now, you go to, when is this? We're just saying NVIDIA, for example. A year from now will be July 2026, right? Let's just do May or June. That's fine. June 2026. And what I want you to do is you go and buy an in-the-money call for NVIDIA. Okay? So let's say you had 3,500. You buy 165 call for NVIDIA. Are you guys following so far?
Yes.
Yes.
So
Yes.
let's say I have 3,000, I'm buying, right? Now, in a year, I have shares of NVIDIA that's going to come to me that I can exercise in the money. Because right now, NVIDIA is 172. I'm buying it at freaking 3,300. And at the same time, you sell this, after you sold it, then almost like owning 100 of the shares, then you just come sell the covered call. Because then it's protecting you. But here's the question. In a year, what's going to happen to the value of that leap contract? It's going to keep going up. You're going to get deeper and deeper in the money. And at the same time, you're going to be selling calls on it and making monthly cash flow or bi-weekly cash flow. So pretty much at the end of the year, you bought that thing for free.
Wow.
And after buying it for free, you're still generating cash flow from it, week after week, month after month.
It's a compounding.
Compounding. And remember, you still own the leap. So imagine when literally Meta dropped to 480. Imagine you bought a leap on Meta. Imagine you sold cash secured puts on Meta and you got filled. Imagine you sold covered calls on Meta. So many things you can do, so many options you have if you understand these strategies. But what I like to do, like I said, when I get something from the cash flow side, if I don't need it immediately, I'm going to go and buy free lottery tickets. I'm just going to buy swings. That's it. Because remember, with the swings, the income potential on the buy side is what? It's unlimited. So it's the hybrid method you're mixing both.
Wow.
Okay. So that's the class for today, guys. Any questions about this?
This is so exciting. Oh my gosh, guys. What? Are y'all serious?
And then everybody's talking about, oh,
What?
buy puts, buy this, buy that. I'm like, if I just tell you how deep options is, and remember, guys, I only went over 50% of the material today. There's a lot more, but just these four alone can be a game changer. Because, for example, I know Meta earnings is in 2 weeks. Okay. 640 is all the way down here. It's very rare Meta's going to get here in 2 weeks. I can just go sell a cash secured put, make extra cash flow as it shows up, and then take that put and buy a lotto ticket for earnings and let the premium shoot up and I catch the ride up.
Wow.
Right. This stuff is like mind blowing.
That's the thing, 'cause when you think of,
Wow.
at that point, you can manipulate whatever you want to manipulate because options are both sides. Right. So I wanted to show you guys how you can generate income literally just from having cash, right? Your favorite companies that are cheap, AMD, say 156 right now. I can literally go to AMD chain
Thank you.
and decide to sell a cash secured puts for 2 weeks from now and say, hey, I like AMD. I want to buy AMD at freaking $148 or whatever the case may be, 18%. For every $14,000 I have, I'm going to get paid $180 in premium. So if you have 10 of them or 20 of them or 30 of these contracts, you can start seeing how you can start really making a living from this. As your capital increases, that's what you want to do. So I want to show you guys one more thing, and then I will call it a wrap. I actually pulled up a calculator, and I did this. So I'll show you this. If you had a 5K account growing 2% a week, and if you're doing IA condos, you're making about 2.7%. So in between 1.7 and 2.7% a week.
Wow,
If
look
you
at
started
this.
if you start at age 30, in 15 years, with a $5,000 account growing 2% a week, you're going to end up with 220 million.
Wow.
Man, that's crazy.
That's beautiful. Sign me up, coach.
If you don't take any, just
Sign
certain
me up.
strategies.
Beautiful.
These are people who are not
Wow.
willing to be patient. So if you literally
Mhm.
because at the end of 1 year, you'll be at 10 grand. And at the end of 2 years, 20. Year 3, 42. Year 4, 86. By year 5 to 7, you're generating literally a 400K salary from this. Now, let's go to the 10K account.
That's something hell.
Sign me up.
Are you guys seeing the ending balance of
Mhm.
right? 20K account.
Wow.
So this stuff works, right? Even if you're making 1% a week, just divide the numbers and have, instead of having 432 million, you have 180 million. Oh, sad day at the office, you know? No, seriously,
That was always so funny.
the hardest part for people is the beginning. When you're making
Right.
$100 or $50, it doesn't seem like much. I'm like, then am I going to do it $50? Or am I going to do $80? That's why I use the hybrid method where I will swing some of the capital that I make from cash secured put. But if you just stick to it, you will, like, you're going to grow your account doing this, right? Being conservative. And by year 15, look at where you are. It's unimaginable. Now, the more cash you start with, like I said, if you start with around 100,000, you can be probably making 80 to 180,000 miles a year from doing this. So I want to kind of show you guys that. What I will do is that if any of you guys want to a more, I guess, one-on-one session with this, I will make some time available where we can maybe discuss your personal account for like an hourly rate or hourly call or something like that. But remember what I said I do with the cash I generate from these? So on the buy side, I teach you guys a lot about the buy side. I want to kind of get you guys a peek into the world on the sell side and what you can actually do once you understand and you master both. Any final questions, my peeps? Listen, you need better than 15 years, then you gotta get more cash. Listen.
Josh, we gotta talk. Well, we gotta talk, Josh. I'm serious. You know how old I am, Josh. We gotta talk.
Don't worry, I'll pull up back in America. You be the getaway driver. No, seriously. No, seriously. I was trying to do some of this stuff way, 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 way earlier, and I started using it way, way earlier. I started selling maybe 2018. But yeah, it works. I've been doing it. Again, depend on your cash. If in the beginning, those $1,500 a week might seem like they said, but I promise you, they compound. $100 a week, extra $100 a month, free cash, 5%. Like I said, when you're selling, the probability of you winning is way higher. You're just making a less amount. So you just have to decide what's more important to you.
Okay, Josh, let's make an appointment. I'm ready.
Okay, I'll put a link in the WhatsApp group for everybody who wants it. And everybody else who just joined, just feel free to shoot me a text or email. You guys all have my number. And I will post this recording in the WhatsApp group so you guys can have it.
Hey, Josh, I do got a question. I know it was like when Facebook was kind of dropping, I wanted to put in a put for that, but I clicked on that same side which it was on, and it never allowed me into those trades. Is that because where the strike price was at? That's like, say if it's at 600 on the strike price for a put, that's really 60,000.
Yes. So if you're just doing the cash secured, which means you're just selling the option, then you will need the cash, which is 60,000 in the account. But if you're doing what I showed you, which is a vertical, and I'll show you the difference between a vertical and the spread now. So I want to make sure you guys understand this. So if Meta, let's say I had 65,000, right? And I just want to sell, right? Okay, I'll then 20% chance Meta is going to get to 655 in the next 2 weeks. I can make literally an extra $655 in 2 weeks if I had 70,000. All I do is hit sell single. I hit confirm and send. Let me put one. And look at this. I'm going to get credited $680 minus a little 65 cents fee immediately. But I have to have the $65,000 in my account balance to cover that. That's why it's called a cash secured put. If you don't have the 65,000, you do what's called a vertical. Same idea, as long as Tesla doesn't get to 650. So what you do is that you sell a vertical, which you're selling the 650, and you're buying a put on the other side to cover the rest of the money you don't have. So let's say I do a 640. That means I'm risking $1,000. I have to cover the difference between 650 and 640. So I'm risking $1,000, but instead of getting paid $680, I'm getting paid $180.
How you know you're risking 1,000? Okay, because the max profit is 1,000. Is that how you know you're risking 1,000?
Now look at it. I'll tell you. Look, this is 6. That's why I said 1,000. Let's do 1. Look at this. You're making $180 max profit, and your max loss is $820. The reason it says your max loss is $820 instead of $1,000 is because you got paid $180 to place the trade. You get it?
Yes, I see that.
So if you have $1,000, I can literally place this trade on Meta, even though I have nowhere near $65,000. As long as I have $1,000 in my account, I can place this trade. And as long as Meta doesn't come to $650 by August 1st, I'm going to make $180 immediately for placing that trade. So let's say I had $10,000. Now in 2 weeks, I just made $1,800. Is that right? Let's see it together. Let's see if I do 10. Or is it $1,000? Nope, $1,800. Max profit, $1,800. Max loss, $8,200 for placing this trade. As long as Meta doesn't get to 650 in the next 2 weeks, and I had $10,000 account balance, I can put $1,800 in my back pocket.
Hey Josh, when you're placing these orders, is that something we have to watch and close, or will it close out on its own? Because
Great question. So with Fidget Firm, they close that on its own. Different brokerages might do it for you, might not do it for you. But what I advise you to do is every day just watch where it's at and close it out. Let's say because it's 2 weeks by like July 31st, you can close it out to get the maximum profit. But remember, let's say by this Friday, it tells me like, okay, right now if you close it out, we're gonna get you to keep $1,000 worth of this. This is now your choice to make. Do you want to wait an extra week for that extra 800, or do you want to take this $1,000 to secure that profit? Because as it goes up, this premium is going to keep going down and down and down and down. And because you sold it, you can buy it back for a lower amount. If you sold it at 1,800, you can buy it back at $800. That's a vertical. So imagine having a $10,000 account and putting $1,800 in your pocket for winning food. And because of what I bought, there's only a 18% probability of it happening. Okay, and remember, you can put the probabilities more in your favor. Like, we're clearly in an uptrend, right? Okay. So, like this trend line where it broke and you expect it to go up, like AMD, this will be the perfect time. Not only would I be thinking about buying calls, okay, I'll be thinking about doing a vertical. Or I can do both. I can sell and collect the vertical, collect the $1,800 premium, and then go ahead, take that $1,800 and put it into calls and catch the ride up.
Hey Josh, can you look? Is it possible if you can look at block because they are rising up? That's possible. Is it? I can
So
put
what
in
is-
a call on that.
What is
So with AMD, sorry,
XYZ.
XYZ? Okay, I'll get into a second.
real quick. So with AMD, you would buy and call at the 134, like where you were just like having the mouse.
So if this is what I saw on this day, because we're here right now,
Right.
here at 142, right?
Mhm.
I'm at AMD. I will literally go to what it says is 15%. And this is where you can get as aggressive or as safe as you want. Okay. You can do the middle and do, okay, 15% chance that AMD is going to get to 144. Okay. I'm going to sell a vertical on this. Okay. 144, 134. That's 10 points. That's $1,000. For that $1,000 of risk, I'm going to get paid $76 per contract. If I do this 10 times, if I enter 10 contracts, I'm going to get paid $760 and I only need $92,400 in cash to execute this trade. Now, if you want to be super aggressive, because remember, as soon as this trade gets executed, that money enters your account. You can actually turn around and take that $760 and then take that $760 they pay you, go to the September 19th, and buy 200 calls for AMD. I'll let that sit. I'll let that sit on you guys for a while.
So Josh, once the profit's in your account, what's stopping you from just taking? I could just take the money out and then hop back in, right?
Yes, that's the thing. You can hop back in. Just be aware that you have to watch it and make sure it doesn't get below that amount. So that's the risk you're taking, right? Like for example, if on day 4 we start shooting up like this, I'm gonna know that we're not gonna come all the way back down here in 5 days, in 3 days. That's almost like. And what's gonna
The
happen?
percentage
It's
not gonna
almost. And
happen.
what's gonna happen is as it goes up, you might have bought at 0.5%, but as it goes up, it's gonna get to like 0.01%. At that point, just consider that money as good as yours. So, for example, if I bought at 0.15% for $249, I got paid $249 in premium. By the time I get to 0.02%, it's only worth $28. So I can sell back $250, hold out the trade early for $28, and keep the difference, which is like $224 per contract.
Gotcha. That's crazy.
Mm-hmm. Yes, that's it. So obviously these strategies, you can see that you have to do a little bit more thinking. And I try not to share because I don't want to overwhelm people, but at the same time, it's like, I feel like it's almost illegal not to share with you guys the other side of what you can do with this. And if you want to if you're like, I want to generate income from this, okay? This is another way to do it. Remember, there's the multiplication side where you're the buyer, and there's the income generating side where you're the seller. You can do both, right? On the sell side, you have to have more knowledge, a little bit more expertise. On the buy side, you don't have to think too hard. Your max loss is the cost of the premium. That's it. Right? But I always like to be a seller, not only a buyer. So I wanted to show you guys that. And at the very least, literally, if you go and research 3 things, the wheel strategy and cash secured puts and covered calls, that's like options 1 or 2. That alone will take you very, very far. You can generate income from it if you have cash. If you have less cash, then you have to start getting into more advanced strategies like iron condors and vertical and stuff like I showed you today. Now, Marcel, you said something like HOD. What's the name of the thing?
No, XYZ.
XYZ. And what stock is this?
Block.
Like blockchain? I've never heard of it.
The Cash App, they switched it to, the
Oh,
block.
yeah. So let's say you draw a trend line, right, on block, and you think that block is about to explode. Or over here. There we go. Over here, right, on this particular day, you think, okay, we broke the trend line. We're about to go up. You can do 2 things. You can sell puts on it to collect the guaranteed premium and buy calls on it to catch the upside. So what question are you asking? What would I do with it? So let's say I want to generate weekly cash flow. Every week I want to generate weekly cash flow. Well, because we are 2 days ago, I don't know what the premium was, but let's just say we're here. And I think that it wants to keep going up. I'm going to go to about 0.17%. Or you can be a little bit more aggressive because you think, here's the thing, if you think this thing is about to rage up, like over here, you buy calls about to rage, okay. You could just be a little bit more aggressive and go to like 20% or 22% and get paid $136 per contract you sell. This would be a cash secured put. Are you paying attention?
Yes, but I want it to go up, not a put, but if I wanted to put a call or
Yeah, so when you sell a put, it means that you think it's going to go up. So you can sell a put for weekly cash flow and at the same time buy a call. Let's say you go a month out, and you can also buy a call. So let's say you get paid $130 for selling it. You could go here and buy 290 calls for August from the premium you just collected selling it.
Oh my gosh. Awesome.
Are you following?
Is this a weekly? I saw like you were choosing weeklies. Is that like that?
So I sell, it depends on how frequently you want to get paid. I like getting paid weekly, so I do weeklies and bi-weekly. But you can go bi-weekly and then you probably get paid more for it. So what is it, 21%? So instead of the 130, you're going to get paid 156. Why wait twice as long to make only $30 more?
And so
Right,
within
exactly.
71 strike, is that going to be 7,100?
If you're just selling a put, 71 strike times 100, then you only need $7,100 in your account to make
Okay.
$130 a week.
I see what you're saying.
Right? That's if you're doing a cover. That's if you're doing a cash security put. which is a safe method because worst case scenario, all it's going to do is they're going to give you the shares. And once you get the shares, you just go on the other side and you sell the covered calls at a high percentage and make your money back. But if you have less capital, now you do something called that's a spread, where now you go to, okay, I'm going to sell, and we can do the same one, right? Let's say you want to take the same amount of things. So you sell a vertical. So now you're selling the 70 and then you're buying the 65. I mean, now you can buy the 60, sorry. You sell the 70, you buy the 60.
And that's what makes it the insurance because you're managing the middle.
Because yes, so your risk
I
is
see it now.
$1,000.
Mhm.
Now, instead of needing $7,000 to make $130, you only need $1,000 to make $110. So what does that allow you to do? With that same $7,000 in capital, okay, instead of making $130, now with that same $700,000 in capital, now you're making $770. The difference is the risk. Here's the difference in the risk. The first one, the cash secured put, if you sell it, if it gets to $70, you get assigned the shares, and you go to the other side. That's the worst thing that can happen. You get assigned the shares, and then you go to the other side and start selling. On this side, you're putting the whole $7,000 in risk. So if it gets to 70, that whole $7,000 pretty much you can lose it. But you don't lose it as soon as it gets to 70. The more lower it goes, the more of your capital you lose. So you can manage your trade as well. So this is where the decision comes in, which is why when people do verticals, instead of doing with cash secured puts, sometimes we go as high as 30% because they know they're going outside and sell it. But when you're doing cash secured puts, sometimes people become more conservative and then they will do like a 5% chance or a 10% chance. So now they'll do 67 and 57. Same $1,000 risk, but you see you're getting paid like half the premium. But the percentage of it happening is only 18%. And the lower you go, a lot of people do 5%. So the $64 put and the $54 put, you're only going to get paid $8. That's not even right. What are we doing at that?
But that's still $1,000 risk, though, correct?
Yeah, there's still $1,000
Yeah,
risk,
okay.
but the chances of it happening is 5%. But here's the thing: we're not only going based on the options chain, we're going based on the chart. If it's showing you a bullish indication, that 5% actually becomes even less likely because of the direction of the stock itself. Does that make sense? So you're stacking the probability in your favor.
Yeah, man, this is a lot, bro. I didn't know it get this deep, and you saying it gets even deeper.
It does. It does, though. It really does. It does. But I just wanted to show you what people are literally doing every day with options. Just imagine it.
Yeah, bro, this is deep, man.
This is what I want to do.
This is deep, dog.
That's why I didn't want to share it, but I said that.
No, you have to share this with us. No,
Yeah, you
absolutely
do.
not. Absolutely
Yeah.
not. This
So
is
let me stick to it. As always, I'll keep giving you guys the call outs. If you just want to keep buying, buy. That's perfectly fine. But sometimes you might see me like I do both. So it just really depends. And sometimes, like for example, let's say you're a buyer and it's just get to just have this in your repertoire. Let's say you like a company, like one of you guys loves AMD, and you want to buy it for the long term. The AMD is gonna get to $500. Okay,
Mm-hmm.
a bill comes up that's $10,000. How are you gonna pay for it? Oh, okay. I'm gonna go to AMD, and I'm gonna go cash secured puts, and I'm just gonna sell. I'm gonna sell 20 of these. A 26% probability this is going to happen, but I think AMD is going up, so I'm probably going to expire worthless. And I'm going to get 5K. All I need is $295,000. And I get 5K pretty much bi-weekly, which is 10 grand a month. So I do it twice. I just made that extra 10K a month. Let's say it expires worthless, I get to do it the month after that. But now you're building cash flow you can use to invest. That's why I like the selling side. It's giving you cash flow you can use to build building blocks for extra cash that you're investing in other things, in other options plays, in your long calls, in your Airbnb business, whatever the case may be. So you guys are seeing what it is. And there's a way to hack the system. So like INTC, for example, is $1 billion company. Last year, they made $50 billion in revenue, but the stock price is only $23.
Mm.
If you notice, for the last, I don't know how many, 3 years, it stayed between $17 and $27. This will be perfect for an iron condor. Perfect. So I'll go to INTC, and let's say I want to get paid bi-weekly. And we said, what was it? $17,
Mhm.
1367 and 27. Perfect. So I will then go to 1767, is at 4%. Okay. And I'm going to give it, it's on the call side. Make sure the put side. And we said 27 was the highest, right? We can literally do 30. That's like 13 points. And on this side, on the call side, 5% is literally at 25. So let's do 25. I'm going to sell at 25. And I'm going to buy 13, which is 28 up. Is it 25, 28? No, 38, sorry. Okay. So it's telling me right now that it's not valid. And the reason is because the 38 chain is not out yet. Right. So I have to fix that. And I have to make this 10 as well. 17. Let me make this.
Why do you make it 10?
It's not, it doesn't give you an options chain that low. That low.
No, but like the range, because you've been doing like a range of 10 for a lot of the different.
So okay, great. So I use for my premiums, I use a range of 10 because
Oh, okay.
of the fact that it depends on how much you want to risk. So every 10 is $1,000.
Okay.
You can drag it out as much as possible. So this doesn't have a big options chain. Let me do one with a bigger options chain. Let me do one with a bigger options chain. At that 5% level. So let me sell an iron condor. Okay, 630 points above 600 will be
Oh, all right.
570.
You're so sweet. I love that, Maya.
And then on the call side, 5% on this side, 5% chance is the 840. So I'm going to sell an 840. And buy an 870. I'm going to get paid $142 to do this. Right? And my risk is $3,000 to do this. But that's just all meta. But if you find a stock that's rangy like this, that has a range that doesn't really break, oh, those are perfect to do iron condors on. It's like collecting free money. Like I like to do that. Like I think is BA one of these? No, this one. You know, what's another one that does this? I have to think.
That does what?
That stays in the range for a long time.
Apple.
So Apple is a good one if it stays in the range for a long time, right? So let's say since March, if you were selling doing between 191 and 220 since March, every single week you'd have been making money for free. Are you seeing that?
Wow. Yep.
Because it's been staying in that range. So if I go to Apple, did I do Apple right? And let's say you want to get paid every week. I'm going to go to the 5%. So 13 cents. It's going to be less because you're getting paid weekly versus bi-weekly. But if I did bi-weekly, you get paid more. But 13 cents. And then I'm going to do an iron condor. I'm going to sell a 197 and I'm going to buy a 180. Let me actually make it. Okay. And that 5%, I'm going to sell a 225 and buy a 235.
And we still want all these out of the money, correct? Because I seen you've been doing some in the money as well too.
No, these are all out of the money.
Okay.
And these are all out of the money. Yeah, none of these are in the money. The only time you do in the money is when you're doing a covered call strategy, where you're buying a covered call a year from now in the money, and then you're selling puts monthly out of the money from that. So yeah, so if I did this, usually I do gaps of 30, so it's a $3,000 worth of risk. But for $1,000 worth of risk, I'm going to get paid $12. So each stock pays a different premium. But if I had 6 contracts, $72 a week. Now that's a week. Again, 2 weeks, that's $150. I was about to say $150 every 2 weeks, depending on what you want to do. But that's
You just need $1,000 in your account for this one.
for this trade.
Yeah. How much did you need in your account?
I did 6. To do one of them,
Yeah, sure. Let's do one.
you need 900. Yeah, you need $1,000 in your account. That's it.
$998.
Really, $988 is what you need to make $12 every week, which is
Okay.
$72 a month. Like I said, it compounds, guys. So you can decide when to keep.
Exactly.
If you do it on the biweekly side, you can get paid more. So now you see you get paid double, 31, $3. There's different ways to do it. And you guys are gonna make my head hurt now, but I just want to show you this. Okay. The more cash you have, the more cash you can make. And I do different things depending on different solutions. So I just want to introduce this to you in case I might want to tell you guys once in a while, like, hey guys, I'm selling. Like I know for a fact I'm going to be doing some selling this week, probably tomorrow. So I just want to kind of introduce you guys to the concept of what you guys can do as you grow in your knowledge options trade. But I'll give you guys this recording so you guys can watch it over and over again.
Thank you.
And then go from there.
I feel like I'm in college. Like I'm like,
Right.
oh my God, this is like I need like the 10 to 16 weeks of a semester on this just one topic. Like
Right. Yeah, that's a lot.
Now seriously, and when people do it all the time, I mean, you look at it right now as one thing, it really goes deeper and deeper and deeper. I'll give you an example. If you think the stock market is going to crash, right? Let's just say I go to SPY. Right? Like over here where we broke this trend line to the downside on SPY, and that's when the terrorists are. If you think the stock market is going to crash, you have 2 options or 3 options. Number 1, you can buy a put on this. Right? You can buy a put and say, okay, as the stock market goes down, I want to make money. Or you can do the opposite. You can sell a call on. And by selling the call, you get paid premium. And that premium you get paid, then you can put it into the puts. Are you guys starting to see like the different options you have depending on what side of the side of the ledger you want to be on?
Yep. I know you said that this was easier than day trading, man. It seemed like there's a lot more to it than that than day trading.
No. So this side where you're selling, I told you have to do a little bit more thinking. But again, you can decide to ignore everything I told you today and literally just ignore it and say, Josh, I don't care what you said. I'm going to do something simple. And all I'm going to do is this, okay? When target breaks over this trend line, I'm going to buy calls and make money. You can do that. I'm just giving you tools that you can use as you grow and you mature.
Thank you. I appreciate it. Thank you.
Yeah. So
Thank you, man.
if you want to know what to do with this, you don't have to. And I promise you, I won't be mad at you and I won't be grouchy, okay? You can just so you can just wait for the trend line break. Like we have a meeting this Wednesday for us in this WhatsApp group. We're gonna go over this. I'm not gonna spend a lot of time teaching what I taught tonight. I want to just do a special class to show you guys the side of it. But we can just buy calls and buy puts and never worry about anything again in our life.
What companies are you looking for as far as shorting this week so that I can be able to keep, or we can be able to keep out as well?
Yes.
Great question.
And would Amazon,
Great question.
would Amazon be one of them that's on your list?
So I'm looking at Meta.
Yeah. Okay.
Not to short. What do you mean? Are you asking me to short or to sell options on?
Well, I think. Well, you had said that you said this week that you.
So for example, right now Meta, right? Meta's comes out with earnings in 2 weeks, right? And I'm expecting a runnings under, and it's holding this level. So I could buy a call here, or I could just sell a put for under here and collect that guaranteed income, which I think I'm going to do. I'm going to probably sell or do a vertical on Meta. So instead of buying $1,000 as a call, I might just say, hey, What's that price right here? What's this? 676? Okay, great. 676 is right here, right? 675. So I can literally get paid $146 for doing this. And this is right at the 10%. So I'm comfortable with this. Sometimes I'll do 5, sometimes I'll do 10. I'll just do a vertical. And then I'm risking $1,000. I want to risk $1,000, so I'll do 660. So for $1,000, I'm going to collect $66 in guaranteed cash up front.
Thank you.
I put 6, right? I'm going to collect $66 guaranteed cash. But the way I do it, I'm not going to buy 1. I might buy 10. Hey, remember, this is a week. That means by Friday, Meta has to get to 670. Which
So then, and
2,000.
then on Friday you would cut the thing like
on
you
Friday, I will close it and
fill it?
buy it back, and I'm going to keep 90 to 95% of this premium, which is
Wait, what do you mean close it and buy it back? You just close it.
Okay, so
just
for
close the
example,
trade.
let's say it stays the same, the numbers are going to fluctuate, or it goes up. This number is going to start being worth less and less and less, but I can buy it back anywhere through this trade. Just like when you buy calls, as you get closer to the money, your premium increases.
Mhm.
The same way, when you sell, as you're getting more out of the money, your premium decreases, and you can
Right.
buy it back at any time. So I might have sold it for $66, but I can buy it back at $28. So let's say by Wednesday, I can keep $300 and only be in a trade for 3 days. I might decide to do that. It's a personal choice. Or I can wait till Friday and keep the whole $660. And this is only going to require me to have a $10,000 account. But let's say I have a $20,000 account per se.
You need 20. Yeah.
And here's the thing. I'm not telling you to put your whole account in there. I'm going to show you what I have done in the past and what's possible. But let's say you have a $50,000 account. You can put half of your account into a trade. That's 90% likely to go in your favor in 7 days. When you sell, time works in your favor. When you buy, time works against you.
Mm.
Right? So the closer you get to the expiration, the more and more money you make. So let's say I do 25 of these bad boys because I have a 30K account. Now for a week, I just made $1,700 in premium. With a $25,000 account, I just put $1,650 in my back pocket for the week.
So when you do that, does that whole basically $23,350 leave your account and you're only left with the $1,650 out of that?
No,
Plus
it
whatever else you had in
doesn't.
there?
It doesn't. It stays in
Oh.
your account, but something's going to open up and it's going to show you where you are. First of all, it's going to start with your profit. Like, okay, is your profit going down or up as we're moving through the chain?
Mhm.
And also, if you eat through that profit, let's say we get to $660 in that time frame, then it starts going. Then it starts going at your $25,000 account. Does that make sense? At that point, it's going to disappear. But here's the thing you have to realize: it doesn't matter what fluctuations happen to your premium, as long as it doesn't get to 670, you're safe. The reason I say that is this: let's say Meta right now is 704, and I executed this trade right. Let's say tomorrow Meta drops down to 700. What's going to happen is that this premium is going to go from 142 to like 170. Now you're going to be mad because you could have made more money if you had waited a day. But that still doesn't matter. It doesn't change the fact that as long as it doesn't get below 670, you're going to get to keep your premium. So no matter what happens, the Meta can go up and down all it wants. As long as it stays below the 670, you're going to get to keep the premium. So selling puts is more beneficial on a red day because you get more premium than usual. So those are little like tips and tricks that you can learn when you want to get deeper into it. But just on a normal day, like I said, weekly income, I can execute this iron condor, this vertical spread, and put $1,650 in my pocket with a 25K account and do it again next week. And over 4 weeks, I would have collected 1617 times 4. I'd have collected $6,468 with a 25K account.
Wow, that's like a six-figure salary.
That's what I'm telling you.
Wait, no, I'm sorry, I did that wrong. My bad.
No, that's about a 6-figure salary. Because think about it, times 12, that's $77,616 cash. Now, granted, if you're making $100K a year, that's right about what you're net, about $77,616 a year.
True, you're right with the taxes. You're right.
Yeah, with a 25K account.
Oh, that's dope.
And so with these, Josh, do we still like have a stop loss with these, or we won't have that since we'll be keeping an eye on that daily? Or be closing out at the end of the week?
Great questions. And this is another reason why I like to do weekly and bi-weeklies. So yes, I keep an eye on it every day. You can put a stop loss on it for sure at like triple what you got in. So it can stop you out at break even or whatever the case may be. But I keep an eye on my stuff daily. Just because I'm in for like 5 to 7 days. So like on a Friday, I would buy this or sell this, and then I'll wait to the next Friday and then keep an eye out on it.
And do you change it to the GTC, or you still
good to
keep it?
Kev. Yes, good to Kev.
Okay, thank you.
Shit.
Yes. So that's how you do directional. So if you don't think meta is gonna get this low, you can do it. If you think the opposite way, like, okay, we're not gonna get past 740, you just come here and then you do the opposite thing. You sell calls. Right? 740. And then you put the 10, which is 750. And now you get what you get paid for that premium, $54.
Yeah, man, this is next level right here, bro. This is next level. This
I-
is
I
this is
still
like
don't-
college, bro. This is like
I know.
And you got me at, you can create your own insurance company. Because now my head's spinning. Thank you.
You're welcome. You're welcome, guys. Yeah, I was struggling with sharing it with you guys, but I was like, let me at least let you guys know it exists. So when you talk to people like, Josh didn't teach you that, I'm like, no, I did tell you this. Again, this is to make you aware of what's possible. The basic you can do is just buy your calls and puts and just be on the income multiplying side. I just want to show you the other side as well, the cash generating side, depending on where you are. So that being said, guys, I'm gonna go chill, call it a night here, and send you the recording when it's done. It was a blast hanging out with you.
thank you,
Thank you,
sir.
Josh. So
Thank
much.
you, Josh.
So much.
Appreciate it.
Thank you.